This example problem is about entries for capital leases from the lessee side. So we can see here that the problem says Ernie Inc. entered into an agreement with Frosty Inc. to lease equipment for use in its ski manufacturing facility. The lease is appropriately recorded as a purchase by Ernie and as a sale by Frosty. The agreement specifies that lease payments will be made on an annual basis. The cost of the machine is reported as inventory on Frosty's accounting records. Because of extensive changes in ski manufacturing technology, the machine is not expected to have a residual value. Ernie uses straight-line depreciation and computes depreciation to the nearest month. After 3 years, Ernie purchases the machine from Frosty. Annual lease payments do not include executory costs. Other terms of the agreement are as follows. So machine cost is recorded. The machine cost recorded at inventory is $3.7 million. The price at the purchase option date is $3.25 million. The lease payments each year will be $710,000. Contract interest rate is 10%. The contract date in the first lease payment is on October 1st, 2011. The date that Ernie purchases the equipment is October 1st, 2014, and the lease period is 8 years. And we are supposed to make entries in 2011 to record the first lease payment and make adjustments necessary at December 31st, the end of each company's fiscal year. We want to record all entries required in 2012 and then prepare the entries in 2014 to record purchase by Ernie, assuming that no previous entries have been made during the year in connection with the lease. So to make the entries in 2011 and record the first lease payment, first we're going to record the actual lease, and that's these entries right here. A debit to leased equipment for $4,166,577, and that is to calculate the value of the lease with the financial calculator. You have 8 payment periods, and that was specified right here. Your interest rate is 10%. Your payment is $710,000. Your future value is 0. There was no residual value, and you will get, when you compute the present value, it's $4,166,577, and we credit that amount to obligations under capital leases. Now on the same day, October 1st, 2011, we are going to debit obligations under capital leases as well, because this is our first payment. The entry is for the first payment on the same day that the lease is formed, so the full payment here is going to the principal, and of course you have cash going out of $710,000. 3 months later, on December 31st of the same year, you have a debit to interest expense for $86,415. This is to record the accrual of interest for 3 months, and you credit obligations under capital leases. On the same day, you have an amortization expense of leased equipment. This is to record the amortization for 3 months. You take the $4,166,577, you divide that by 8, and then you times that by 3/12 for 3 months. That gives you $130,206. Now, on October 1st, we're jumping from 2011 to October 1st, 2014. We're going to have amortization expense of leased equipment for $390,617. That's to record the amortization for 9 months in that year. So you take the $4,166,577 divided by 8, times that by 9/12, and that gives you $390,617. Then you have accumulated amortization on leased equipment of the same amount, $390,617. On that date, you have interest expense. This is to record the accrual of interest for 9 months up until October 1st in that year. So we refer to this table to get the interest. You'll see on the fourth payment of $269,146, you multiply the amount by 9/12. So we have a table here of the interest expense, and in this table you have the lease value, your principal, interest expense, and the actual payment. So right here is your beginning balance of the lease value. The first payment was $710,000. There was no interest because that was the same day the lease was formed, so the full amount went to the principal. So that lowered the lease by $710,000. So that brought you to this amount. And on the next payment, you had $710,000, but you times this 3456577 by 10%. That will give you 345,658. You subtract this from your payment. That leaves you with 364,342 going towards the principal, and that leaves you with 3,092,235 in the lease value. And it just goes on until the purchase happens right here. And so we take this interest expense of 269,146, like our note says right here. We multiply that by 9/12. That gives us 201,860. And then of course we credit obligations under capital leases because we're reducing the obligation by that much. And then these entries right here are to record the purchase. So we'll start down here. This is the amount of the purchase option, so that's just paid out in cash. And then this is the full amount of the lease to take this off the books, 416,6577. Then we have accumulated amortization for 3 years. That's 520,821 times 3. That leaves us with 1,562,463. The obligations under capital leases, this is the principal balance at the time of the purchase from the table, 296,0602. 296,0602. That's the principal lease, or the value left in the lease that has to be paid off. And we are debiting equipment. This is the amount that's going to stay on our books of the equipment, 2,893,515. And that is how you do that problem.